Hello, everyone, and welcome to another episode of Gray Matter. One of the voices that I follow on Substack, besides the guest that we're going to have on today, is Rod Dreyer, the American author. He recently posted a piece entitled Goodbye Middle Class, It's Been Fun, talking about the rising cost of living. And of course, this is frightening many people. Many people are very concerned. What's happening? We know that there are great economic changes happening. We don't understand what they're all about. One of the voices in the wilderness who has been making sense of all this for a long time and still is our guest, John Rubino. He's a gold bug, crisis investor, author, or co-author of 5 books on investing that we're going to be talking about today. He's also the founder and editor of dollarcollapse.com until he sold it in 2022. And he looks for ways to survive and thrive in chaotic times. Welcome to the show, John. It's great to have you on our program today.
Leighton, thanks for having me on. It's good to meet you.
So before we sort of pick the brain of this man who's been looking at economic crises for a long time and making sense of them, we're going to go to some of our framing aphorisms as we always do. Won't surprise you to expect that this would have a bit of a gold theme today. One of them, the first one, is from Alan Greenspan, who's a noted American economist. He said, in almost hysterical antagonism toward the gold standard, gold and economic freedom are inseparable. I expect our guest would agree with that. Another one from famous investor J.P. Morgan. Gold is money and everything else is credit. From King Ferdinand of Spain way back in 1511, he coined this immortal phrase. He said, get gold humanely, if possible. Spain didn't always do that, but at all hazards, get gold. And finally, going even further back in history to Seneca, the great Grecian philosopher, who said, fire tries gold, misfortune tries brave men. Well, who do we have in the show today? Well, John Rubino runs the popular financial website dollarcollapse.com, and he contributes regularly to CFA magazine. His books, which we'll talk about, include The Money Bubble, which he co-authored with James Turk in 2013, Clean Money, Picking Winners in the Green Tech Boom, that's from 2008, The Collapse of the Dollar and How to Profit from It, also with Gold Money's James Turk in 2008, How to Profit from the Coming Real Estate Bust. That was back in 2003. So obviously he has some ideas, some ability to predict the future. And he also has written a book called Main Street, Not Wall Street. That was from 1998. After earning a finance MBA from New York University, he spent the 1980s on Wall Street as a Eurodollar trader, equity analyst, and junk bond analyst. Something out of an Oliver Stone movie, as I recall. During the 1990s, he was a featured columnist with TheStreet.com and a frequent contributor to Individual Investor, Online Investor, and Consumers Digest, among many other publications. So, John, I did some research, especially on gold that you talk about a lot on your Substack and in your writings. I found this, and I want to ask you about, and maybe talk a little bit about gold off the top. Gold is so rare that the world pours more steel in an hour than it has poured gold since the beginning of recorded history. That really, I was thunderstruck by that. What is it about gold that is so fascinating throughout history and is so important in terms of the world economy right now?
Well, Leighton, a couple of very quick corrections to the intro first.
Sorry about that.
Yeah, I don't run dollarcollapse.com anymore. I sold that a couple of years ago.
Right,
and
in 2022.
Now I have a Substack at rubino.substack.com where all my writing is published.
Yeah, and that's where I found you. People should check that out, by the way.
Thanks. Yeah, it's been a fun little community that's building up around that newsletter. So I'm enjoying the process. But yeah, gold has been basically humanity's money for 3,000 years now. And to make sense of that, you kind of have to understand what money is. And to understand that, you have to go back to before there was money. You know, the original human civilizations were based on barter, where if I have some arrowheads and you have some beaver pelts, we work out a deal and we do a trade and move on. But as societies get more complex, they can't function on just barter because that requires too many trades to get from, say, speech therapy to pork chops or something like that.
Right.
Um,
Right. Hmm.
so every society starts looking around for something to serve as a kind of an intermediary, a communications medium, and a store of value. That is what money is. So that we over throughout history we've tried human slaves and animals and bales of dried tea leaves and big rocks, and um, all of them worked a little bit, but not very well. And eventually, people settled on pieces of metal like gold, silver, and copper because they can be made in identical pieces, so you know exactly what you're getting. They're all rare,
Hmm.
so they tend to hold their value. And gold ended up being the best of all of those things, and it stayed as humanity's money up until like 1971. The
Hmm.
problem with using a rare thing as money is that it limits the ability of governments to just go out and invade their neighbors and buy elections and do all the things that governments like to do. So governments hate the limitations on the money supply that being on a gold standard monetary system imposes.
We all hate
So
limitations on our money supply,
we
don't we?
we all do that, yeah. And so the difference being, though, that governments can actually grant themselves the ability to create money out of thin air. And so in
Yeah.
1971, they basically all did that. We went off the gold standard and we went to what is called a fiat currency standard. Fiat
Mhm.
being government decree. They tell us this is the
Right.
money, therefore
Mhm.
it is the money. And
Yeah.
since that time, since it basically handed an unlimited credit card to the world's governments, they've totally abused that power. And we've developed into a society where debt increases exponentially. Everybody is basically either benefiting from the increase in debt or debt slaves now. So you've got
Right.
kind of
Right.
an aristocracy in charge. The people who get the money first when the Federal Reserve creates new money out of thin air tend to get richest because they get to use that money before the increased supply lowers the value of that money. And so now we've got a society where we're basically at the very end point of that fiat currency experiment that started in
Mm.
1971. We've built up so much debt that the debt has become more than unwieldy, and it's now a mortal threat to the global financial
Mhm.
system, and there's no fix. So that's the stage of this process that we're living through right now is historically unprecedented, and it's going to be just fascinating from an economic nerd standpoint. I'm just really interested in what's going on. Most people, it's going to be terrifying though, because
Yeah.
the average person doesn't obsess about this stuff every day, and they
Mhm.
aren't expecting it to happen and they aren't preparing for it to happen. So they're going to be caught off guard. And in other words, the
Mhm.
people who don't deserve to be hurt are the ones who are going to be hurt by the
Mhm.
monetary chaos that's coming.
Yeah.
And that leaves a lot of online talking heads, kind of like me,
Mhm.
trying to tell people what they need to do to get ready for the chaos that's coming. So
Yeah, inflation
fascinating.
is yeah, it is. Inflation is one aspect of this, John, and I mentioned this off the top of the show, but inflation is interesting because it's caused in large part by what you described, this printing of too much money. Governments seem to like inflation because it reduces the value of their debt, but of course the rest of us really don't like it because it also at the same time reduces the value of our savings. But gold has a really interesting relationship to inflation, doesn't it? And correct me if this is wrong, but as inflation erodes the purchasing power of our cash, gold can act as a shield because it maintains its value even as the general price level rises. Is that true?
Yeah, well, gold is the form of money that we pile into when we become terrified about what the government is doing to the money that they're managing. So
Right.
gold tends to rise in local currency terms. In other words, when you measure gold with the currency that is being inflated away, the price of gold goes up. And so that's one of the things you can do to protect yourself from
Mhm.
monetary chaos is you move out of the currency that your government is inflating away and into real things that governments can't inflate away. And that can be
Mhm.
farmland, it can be oil wells, it can be solar farms, it can be really well-chosen rental houses, but it can also be gold and silver. So you get into those two things, those are actual money, and we're going to go back to them as money in the not too distant future. And as people figure this out, more and more of them move into gold and silver. And what happens then is that those are small, thinly traded markets. There just is not that much gold and silver available for purchase when people really get nervous and start trying to buy it. So the price
Mhm.
goes up, and then towards the end of the cycle, it'll go up dramatically. Where you have gold just going to numbers that don't even seem possible right now, and silver going up much faster than gold in percentage terms because it's more
Mhm.
thinly traded. There's just less silver out there in the world, and so that is you could basically call that the investment thesis of the coming decade. You want to move
Very
out of
interesting.
financial assets and into real things like gold and silver.
Mhm. Mhm. You've been talking about this a lot on your Substack and also talking about not just gold and silver themselves, but also stocks, investments that are related to, for example, gold and silver mining. And you talk about mitigating inflation's impact on our wealth, just in the way that you described. And we have seen over the past year or so a really noticeable increase in the value of precious metals, haven't we?
The past couple of years actually have been spectacular run for gold and silver. Well, gold, for instance, bounced off of the $2,000 an ounce level like 3 or 4 times heading up to last year, and then it finally broke through and it just took off. Now it's like $4,100 an ounce, so it's
Yeah.
doubled in a couple of years, which for a form of money for a large asset class like gold, that's a huge move.
Hmm.
And the mining stocks are basically um, sold as leveraged plays on gold. Because what a gold miner is basically a bunch of gold in the ground and then some machinery to get that gold out. So it's kind of like buying gold in a bank vault or something like that. If it's a
Right.
well run
Right.
mining
Hmm.
company, they're going to pull that gold out of the ground, sell it for the new higher price, bank a ton of cash, and then do, you hope, favorable things with that cash. And in a gold and silver bull market, of which we've had a couple since the fiat currency experiment started, um, the miners usually go up even faster than the underlying metals. But of course, they have a lot of risks associated with them that you don't get with just
Right.
the metals. But
Hmm.
if a gold or silver miner is really well run and honestly run, and they have what they say they have in the ground, um, a lot of them are what is called 10 bagger stocks. In other words, they can go up 10 times from where you buy them. And there are a lot of them out there right now. They've had their good initial runs. So the very easy money has been made in the mining sector. But
Right.
a lot of the really good ones have a long, long way to run from here if gold and silver continue to go up.
Hmm.
And I
Hmm.
think there's a pretty good bet that gold and silver continue to go up because the governments of the world have no choice but to inflate away their currency. Like you said, they even if they don't like inflation, because it's a politically risky thing to do, but it is their one way out of an unmanageable pile of debt. And so they're going for it now. I mean, look at what the U.S. government is doing. Even with
Yeah.
conservatives in charge right now, we're running
Yeah.
$2 trillion a year deficits, and
Hmm.
now they're starting to talk about 50-year mortgages and $2,000 stimmy checks, which are basically just panicky ways of getting themselves through the next election.
Yeah.
So when
Yeah.
stuff like that starts happening, that's a sure sign that financial trouble is coming, and gold and silver are probably safe bets to get yourself through them.
Hmm. Hmm. Speaking of the U.S. government, you wrote a piece that was really interesting. It was published on October 19th of this year, entitled "The U.S. Quietly Bails Out Its Banks." Is that is that action part of what you're about what you're talking about? This idea that the government has to continue to inflate currency and kind of keep the things going. Was that part of it? And what was that kind of the crux of that piece?
Yeah, when you're in kind of a currency death spiral like we are now, lots of different sectors will get in trouble. It's not everybody at once going bankrupt in one big week or anything. It's some local and regional banks, and then it's commercial real estate, and then it's private equity. And the government, when confronted with a crisis in one sector that's not dominant but reasonably big, can either let it happen and hope that the crisis doesn't spread to everything else and knock down all the dominoes and just end today's monetary system tomorrow. Or they can
Right.
step in and try to put out that small fire by bailing out the entities that are in trouble. And that's what the governments have been doing for the last 30 years, basically around the world. And that's what our government is doing now, um, or has been doing with local and regional banks. Basically, the smaller banks out there have a lot of real estate paper, for instance. They own a lot of bonds based on office buildings or loans to office buildings. And the office building sector is kind of tanking right now. And what
Hmm.
happened more recently is some private sector or private equity companies, which are these shadow banking kinds of things that aren't regulated the way regular banks are, but still do things like banking. They got into trouble, and everybody was wondering who else was going to blow up after those three or four private equity companies blew up.
Right.
And so people started looking at local and regional banks, for instance, and some of the big banks too, and thinking, okay, is my bank going to go bust? And then they were considering pulling their deposits out, and that could really metastasize. So the government stepped
Wow.
in with basically a bailout, which is
Hmm.
what they call repos, where the government will take some of your asset-backed bonds and give you cash in return, and that cash allows you to pay off your depositors if they want to pull their money out, and that keeps you from going bust.
Sounds
So
like
that's
a
what the government's
Ponzi
been doing
scheme.
lately. Oh, it's totally a Ponzi scheme. Yeah, it absolutely is. We're in that phase of the process,
Wow.
and so the government does that. The government has already done it once before, very recently, with the local and regional banks, and so they're doing it again with banks now. But it
Mm,
could easily be the car makers next, or some other
yeah.
branch of the banking
Yeah.
sector.
Wow.
You just don't know who's going to blow up in a situation like
Mm.
this.
One of
Only
your
that lots
Sorry,
of
go ahead, John.
people are going to blow up. Yeah.
Yeah. Speaking of blowing up, one of the books that you wrote with James Turk was in 2004, The Coming Collapse of the Dollar. And this is a really interesting book because you advise readers to bet against the housing bubble. And this is, of course, before it popped. And you recommended buying gold before it soared. And these were literally the two best investment ideas of the decade. Um, what was it that you and James Turk saw back in 2004 when you wrote that book that allowed you to predict with a high degree of accuracy what was going to come in 2008 with the housing crisis?
Well, based on our perception of the situation back then, the numbers were becoming unmanageable even then. It looked like we should have really had the definitive bust in 2000 when the tech stock bubble burst.
Right.
But we started bailing ourselves out with super low interest rates and various kinds of government direct bailouts, and that bought us some time, but at the cost of a housing bubble that was even in
Mm,
2004 was looking overdone, ready to burst, and James and I were thinking that, okay, when the housing bubble bursts, that is basically going to bring down the financial system. There's no way we bail ourselves out of that when it happens, and so we thought that that would be the thing that ends the fiat currency experiment and basically puts us into a dollar
right. Yeah.
crisis, which leads to a dollar reset, which leads us back to a gold standard. So we thought all that was going to happen in the 2000s. And in fact, when we were writing that book about the coming collapse of the dollar, our big fear was that
Right.
it would all happen before we could get the book published. but but it turns out we were able to buy ourselves another decade and a half by basically just
Yeah.
opening the floodgates. We just took on so much debt. And when I say we, I mean all the big governments around the world. The global
Hmm.
financial system just basically quadrupled its debt
Hmm.
from a level that already looked unmanageable to James Turk and I back then. Um,
Yeah.
we did get through the Great Recession without it ending the global financial system, but at a cost of a massive increase in new debt. So now
Yeah.
we're back there again. We're back in a tech stock bubble and a housing bubble and what they call the
Right.
everything bubble. Actually, now it's going
Yeah.
to burst.
Well, we're still,
And
yeah, your 2008 book, The Money Bubble, which talks about this in hindsight. It's still very, very relevant, isn't it? I mean, this bubble, as you say, the causes of it are still the same. It's just the bubble seems to be getting bigger. Is that a fair way of putting it?
yeah, I mean the bubble is getting bigger than I thought was possible. All right, which makes me a really bad indicator for short-term market moves. I'm not
Yeah.
really good at the timing with this stuff. I'm way too early with everything. But yeah, the money bubble was basically James Turk and I coming out and updating the ideas from the coming collapse of the dollar book.
Hmm.
And it took a really long time for that stuff to start, for the predictions from the money bubble to actually start playing out. But those predictions were, rising interest rates, rising inflation, more and more geopolitical turmoil, more and more monetary turmoil, equity bubbles, all of that stuff we predicted in 2008, but it was a very slow thing coming. But now it's here.
Yeah.
So
Yeah.
all of the stuff that book predicted, which is another way of putting that, of saying that that book is actually pretty timely right now, even though it's more
Yes.
than 10 years old.
Yeah.
Its ideas are basically more useful now than they were back then.
One of the reasons
So
why it's timely is that not only that you were able to accurately diagnose the problems, but you also the principles of sound investing are consistent all the way through your writings, aren't they? So the solutions really haven't
hmm,
changed. You want to talk about that a little bit in terms of how what your approach is to investing in order to try and navigate your way through these problems that are being created by government.
yeah, sound money, which is to say money you can trust not to lose its value and not to be manipulated by big banks and governments. Sound money is a prerequisite for a healthy society because it forces big players out there to tell the truth. When you're working with gold,
Right.
with something that you
Yeah.
can't manipulate, you have to be honest about the situation of the financial world and what you're
Yeah.
doing within it. So in an honest system, then entrepreneurs know how to allocate capital and people know how to invest for their future. And you get organic, steady, inflation-free growth, which is what we got. We went for 200 years on a gold standard, part of which was called the classical gold standard, and there was no inflation back then, leading up to World War One.
Yeah.
The currency just was the environment. It didn't go up and down in value or anything. It just held its value. And so that was a golden age of global economics because people knew what they were going to get back when they made an investment, and that led them to be enthusiastic investors. So we had a world in which people were making good decisions with their capital, and that was generating free cash flow, which made society a better place. Okay, so
Hmm.
sound money is the prerequisite for that kind of a society. And now we emphatically don't have that. We haven't had it since 1971. So we have a very dishonest society where everybody's lying about everything, and you can't trust the value of the currency that you save, even for a year, let alone 10 years or 20 years. And that's leading to basically blind capital allocators. In other words, people who are building factories and otherwise putting money to work have no idea what kind of a world they're going to be living in 5 years or 10 years from now. So they're reluctant, first of all, to invest, or they just throw money blindly at anything that's moving, which is kind of what you get in
Mhm.
stock bubbles, right? Anything that looks hot uh, attracts a ton of capital until that hot asset gets way overvalued, blows up, and then takes a lot of people's nest eggs down with it. So we're
Right.
back there
Yeah.
again, and this time around, it's kind of it's the tech stocks again, and AI
Yeah.
in particular.
Yeah. What you just said, John, is very profound. And I haven't heard it expressed quite that way. You went all the way down and said that in order to have a worthwhile society, a society in which we have freedom and freedom of choice and all the things that we value, we have to have fundamentally truth in our currency. And you drew a line between truth and money, and sort of proper to be in the way that we value things as an expression of truth. That's a very fascinating way of looking at things, and of course, it draws a lot of parallels to other forms of lying that are going on in society. Let's face it. A lot of the things that the fake money is being used to finance and pay for. The other thing that you said that was really interesting a few moments ago is, and I believe you've been talking about this for a while in your writings, and that is that there may be a correction or a reset, if you will, not the great race reset that those people over in Davos talk about, but a bringing back of currency to the gold standard. So I have a two-part question out of that. Number one, what is the probability that that is going to occur? And secondly, what will be the impact of that on, for example, the value of precious metals?
Well, the probability of a currency reset is, I'd say, 95%. With that other
Wow.
5% being the really crazy things like aliens landing on the White House lawn, stuff like that, or a giant war, like a nuclear war, would
Wow.
pretty much put finance on the back burner. But
Yeah.
leaving aside society-threatening crises that have nothing to do with money that come from the outside, we basically have destroyed the world's fiat currencies. They're dying now.
Yeah.
Um, there isn't really a chance of fixing the system as it currently exists and then going on from there. We basically have to end the whole concept of fiat currency and then go to something that involves sound money. It might not be a gold standard again. It might, who knows, might be a Bitcoin standard, might be some other kind
Right.
of commodity standard. That'll be a debate
Or a
when
combination, right?
yeah, yeah.
Mm.
There could be a lot of things based on new financial technology that we might choose as our sound base money for the next
Hmm.
currency system. And again, that's a debate for once it all really hits the fan, and then we're talking about what to do next. Because right now, that's not a
Right.
debate. We're kind of accepting today's system as something that's going to go on into the future, and it's probably not. So,
Interesting.
so yeah,
Wow.
I think it's almost certain that some kind of a currency reset happens. And by the way, currency resets aren't that unusual in life. In Latin America, they lop three zeros off the currency all the time and just go on from there. And we had a currency reset in the 1950s with the Bretton Woods Agreement, and then
Hmm.
another reset when we went off the Bretton Woods Agreement in 1971. So those are things that happen. Governments frequently screw up their currencies and then frequently have to set up a new system. And
Mm.
the difference being this one is global. It's not going to be just the US, it's going to be all the big countries,
Hmm.
either in their own way or all together,
Hmm.
setting up a new currency regime.
Hmm.
And the turmoil that leads up to it is probably going to be bigger than anything the world has ever seen, at least in terms of currencies, because it's everybody now. Everybody has a fiat currency that they've been using to inflate their debt to put off having to live within their means. And,
Yeah.
old or previous currency resets used to happen in sound money worlds. In other words, everybody was on the gold standard, but one country screwed up, and then they had to
Yeah.
do some kind of a currency reset while everybody else was basically okay. Well, nobody else is okay now, or almost nobody. else is okay. The Swiss franc might be a currency that survives. The Russian ruble maybe, because Russia has very little debt and a lot of oil. But there aren't many other countries that are going to be immune from the turmoil that happens when the dollar really starts to fall
Mhm.
in an uncontrollable way.
Mm. There's a Canadian bank that has a campaign that says you're richer than you think. It sounds like the opposite is true. We're actually poorer than we think, or at least we spend as though we have more money than we actually do. When I say me, I mean not only governments but also individuals, because there's the public debt, but then there's also the private debt, and in some ways, the private debt is even more of a problem, isn't it?
Yeah, when we look at debt, people do tend to look at just the government debt, which is about
Yeah.
$40 trillion in the U.S. right now. But there's also unfunded liabilities, which is what the government owes on Social Security and Medicare in the U.S., which is vastly bigger, and it's a real debt. It's an actual obligation, but it's vastly bigger than the government debt or the official national debt. And then there's derivatives, which are these obscure contracts which dwarf unfunded liabilities. And meanwhile, you got private sector debt. The governments of the world, when they run into financial trouble, encourage their citizens to borrow money and to spend it. And that keeps the economy going for a little while longer. So we've got these car mortgages out there now where it's $1,000 a month for 8 years, and we've got home mortgages that eat up way more of the quote unquote homeowners monthly income than they should. And we've got
Right.
student loans that are above $1 trillion now, and the defaults and delinquencies on student loans are going through the roof, and credit card debt that's through the roof, and also going bad at an accelerating rate. So we've got all kinds of private sector debt that is a big deal too. And one way private sector debt might be the cause of the end of public sector debt is if consumers in the U.S., because they're so over indebted, just can't spend anymore. That
Right.
leads us into a recession, which causes an equities bear market, which forces the government to bail out everybody in sight, which shifts the pressure over to the currency. And then we get that currency crisis. And all of that, every step of that process is completely possible and completely logical in today's world. So pay attention to consumer debt, because that might be the catalyst that sets off the crisis that leads to the currency reset.
Hmm. And this currency reset, I'd like to talk about this a little bit because I've heard different stories about it. For example, in the United States has a lot of gold, but I've heard that if this happens, if there's a reset and they go to a gold standard, it'll not only essentially erase that debt that you talked about, that public debt, but also could drive the price of gold, for example, 10 times higher than it is right now. Does that sound conceivable to you, or is that just people dreaming in Technicolor about about the value of their gold?
People talk about the U.S. revaluing its gold because right now, I mean, we claim to have a lot of gold in Fort Knox, and we're holding it for accounting purposes at, like, I think $45 an ounce. So a lot of people say, well, we'll just revalue that gold for $5,000 an ounce, and then that will give the Treasury a lot of new borrowing power. It doesn't make any sense to me because, I mean, the whole world knows how much gold we say we have, and they can do the math. They can know what that gold is worth. So us just changing a note, some notations about the value of the gold for official purposes doesn't change the world's perception of U.S. financial stability in any way at all. And
Mhm, mhm.
so if we were now to use that gold to go on as a gold standard, in other words, to back the currency in a way that makes the currency stable and trustworthy, yes, we'd have to do it at a much higher price. That's not what those guys are talking about when they're talking about revaluing gold. They're talking about just
Okay.
allowing the Treasury to borrow a lot more money. But if we use the gold that we have, assuming we actually have it, to back the U.S. dollar by, say, 40%. In other words, gold accounts for or equals 40% of the dollars that are outstanding and circulating. Um, you would need a way higher gold price for that. So the people who run those numbers and decide what 40% or 60% or 80% backing would mean for the gold price all come to the conclusion that the number is way higher than today. It's $10,000 an ounce and up. Some
Okay.
estimates are up in the like $40,000 range. So
Hmm.
if we went back to a gold standard, that would mean the dollar price of an ounce of gold would go through the roof. So if you've
Mm.
invested in gold, you'd like that scenario, right? We go back
Yeah.
to a sound money standard, which is a good thing, and you get rich because you've got a bunch of gold at $10,000 or $20,000 an ounce.
Right.
So that's the gold bugs dream scenario, right? That they don't
Hmm.
confiscate
Hmm.
our gold, but they do use their gold to go back to a new gold standard at 10 or 20 or $30,000 an ounce, and
Hmm.
conceivable. There's some speed bumps along the way, but that is a thing that's possible in this world.
Yeah. Yeah. One of the things you also talk about recently is on your Substack, you published a piece on November the 3rd entitled Worried About the Gold Silver Correction. Don't be. It's just a head fake. Would you mind talking about that a little bit? Because I notice, as someone who is a gold bug himself, I was a little worried when I saw, the prices fluctuate because it was going up and up and up. And all of a sudden there was this correction, as you call it. Is this something that people who are invested in gold and silver need to worry about, or do you think that the price is going to continue to rise for precious metals going forward?
Well, bull markets always have corrections because what happens when some asset has gone up in price for a while, that creates a lot of people with profits to protect, right? And so they're trying to figure out what they should do about it. A few of them decide to sell a little bit of their holdings. That spooks the other people who are worried but haven't yet started to sell, and then they sell, and then you get a correction. Sometimes that correction is
Yeah.
stomach churning because you get a lot of people who panic sell because they don't want to be round tripped. In other words, they don't
Yeah.
want their asset to go all the way back down to where they started, so they take something. They bail at some price that's positive for them.
Yeah.
And that's very scary when it happens if you're not one of the ones who sold right at the top.
Mhm, mhm.
But bull markets have corrections like that, and then they get going again, and then it goes up to some new high level, and you're very sorry if you sold during the first correction. And with gold
Yeah.
and silver, the thing that dictates their value isn't anything they do. Gold and silver are just basically rocks that sit there, um, and what determines their value is what we're doing to the dollar. In other words, as the US, for instance, is still taking on more and more debt year after year and still creating a lot of new currency out of thin air to finance that debt and the interest costs on that debt, then that means the value of the currency is going to continue to decline as the oversupply gets worse and worse. Which
Mhm,
means
mhm.
gold and silver, when valued in dollars, will continue to get more and more valuable. So corrections, especially this last correction, by calling it a head fake, I was quoting somebody else with that, but the term head fake means it's something that is kind of designed to fool you. To get the
Yeah.
weak hands out of the market to allow the strong hands, strong hands being defined as people who have no intention of selling for a really long time, to come in
Right.
and get one more last shot at cheap metal.
Mhm,
And
mhm.
that's basically what happens. So gold and silver fell pretty dramatically, and then they stabilized, and now they're back up again. They're down today, but
Yeah.
gold is back up above $50 an ounce, and so. Or I'm sorry, silver is back up above $50 an ounce. Gold is above $4,000 an ounce, which is a nice high level. That's a bull market place for those things to be. And
Mhm.
so whether you should jump in with both feet at this price, that's a different story, but you definitely shouldn't just sell out here. Or at least
Yeah.
if this is the kind of bull market that past bull markets have been, then
Mhm.
yeah, you don't want to sell here. You can take a little bit of profit, but you want a nice, solid position in these assets because they have a lot longer to run based on the things that determine their price.
Yeah, and especially you talk about silver. Another piece you wrote in your Substack that was published on October 11th, you asked the question, is silver becoming unobtainium? And is an exchange default imminent? And so what you're part of one of the I guess problems, and not problems, but realities that spin off from what you just said is that some of these assets like silver that used to be very affordable might not be very affordable much longer, right?
Yeah, silver, the world's silver mines don't produce enough silver to satisfy the demand for the metal. So it's been in
Hmm.
deficit for 4 straight years now. And which means that we're using up the original above ground stocks of silver to make missiles and solar panels and electric cars, and for investors to be able to buy to put away as part of the dollar depreciation thesis. Um, and silver is also traded on exchanges where people will have futures contracts that they use to bet on the price of silver going up and down. And the long futures contracts include the provision that you're allowed, if you hold one of those futures contracts, to get physical metal delivered to you.
Uh,
But on the exchanges, there's not nearly enough metal to satisfy the demand of all of those futures contracts if they stood for delivery.
oh,
And
that's a
more of
big
them are
problem.
standing for delivery. Yeah. So these
Mhm.
exchanges are looking at this dwindling amount of physical silver that they have and a growing number of futures contract holders who are calling for delivery, and they're not sure what to do. That's a big problem heading their way. It's an unsolvable dilemma at the moment. And so what happens is that maybe one of these exchanges is just going to flat out run out of silver and they're going to default. And if they
Mm.
do that, then everybody in the world is going to see there's not enough silver, and so everybody is going to pile into it. It just got named a critical metal for the U.S. government, which means the government has a stake in sufficient stockpiles of silver now, because among
Mhm.
other things, silver is used in a lot of high tech weapons. So you'll
Mhm.
see big players stepping in and trying to satisfy their need for silver in the future by buying it in the present for whatever price it takes. And they'll just
Mhm.
they'll pay what they have to pay, because the alternative of not having missiles when we need them, or just running out of solar panels or whatever, that's
Yeah.
unthinkable for the companies who make these things. So they're willing to pay up
Mhm.
for a critical component if that's what it takes. And so that's the silver triple digit thesis, that one
Mhm.
of these exchanges defaults, and then everybody else has to buy silver at whatever the price they have to pay. And silver goes up above $100 an ounce and maybe much further than that. And again, the people who have silver now end up becoming much, much richer.
Mm. Do you think that the silver is lagging behind the increase in the price of gold? In other words, should the relationship between gold and silver be closer than it is right now in price? And do you think that might drive an increase in silver price going forward?
Well, there's a that relationship between gold and silver is denoted by the gold silver ratio, which is the number of silver ounces it takes to buy a gold ounce. And normally that number fluctuates between 80 and 20. In other words, when people want gold and not silver, then the price of gold relative to silver goes up, and you get an 80 or 90 or 100 gold silver ratio.
Mhm.
And then when everybody wants silver, the ratio goes way down into the 30s or 40s or 20s. And we're kind of at the top end of that spectrum right now, where I think the gold silver ratio is like 80 right now, which means silver is relatively cheap compared to gold.
Right.
And that's the way it usually works early in precious metals bull markets, because people buy gold first because that's the big name in the sector.
Right. Mhm.
And
Mhm.
then gold goes up relative to silver. But then people start looking around at what else they should buy besides gold, because gold is way up. An ounce of gold, little tiny thing that you can hold in your hand, is $4,000 now. So they start looking around and looking at how silver compares to gold and concluding that silver is super cheap compared to gold. And so they start buying silver. And that's when silver
Mm.
starts to outperform gold. So we're right at the beginning of that part of the process. Silver has
Oh,
outperformed gold a little
fascinating.
bit lately, but the big outperformance comes later when it starts looking like a bubble, like when everybody is trying to get their hands on gold and silver. That's when silver goes up dramatically versus gold. So now, based on that, now's the time to be buying silver relative to gold because it's just at the beginning of its outperformance stage of the cycle.
Hmm.
So yeah, this is if you're trying to decide between gold and silver, history says silver is the thing that you should be mostly buying right now.
Interesting. John, you've got a background on Wall Street. And one of the things that you wrote about recently is that Wall Street historically has kind of ignored precious metals. They've been focused on stocks and bonds. But you published a piece on September 28th on your Substack saying, well, that looks like that's changing. Do you want to talk about that a little bit? And I know you've talked about some of the reasons why, but how's Wall Street reacting to what's happening with precious metals?
Well, mainstream money managers have never liked gold and silver, in large part because they don't pay dividends, and it's kind of a buy and hold investment. You buy it, you put it away, and that doesn't generate any kind of trading profits for your broker.
Hmm.
So very few mainstream money managers have their clients in gold or silver right now. I think the percentage is like gold is 1% of global investable assets right now. But that's starting to change, in part because stocks are looking really overvalued, and in part because gold has been going up so dramatically that all the clients are coming in to money management shops and saying, "Why don't I have gold? Gold just outperformed the S&P 500 for a whole year. Why don't I have any?" So the mainstream money managers are finding themselves forced to start looking at gold and buying it, and a couple of Wall Street brokerage houses now are starting to amend their old 60-40 portfolio. They used to have this rule of thumb that you should be in 60% stocks, 40% bonds.
Right.
And the bonds will protect you in hard times. The stocks will go up in good times, and you'll
Yeah.
be fine. And then gold is not included in that. Suddenly, it is included in that. There are big investment houses talking about 60-20-20 portfolio where you invest 60%
Mm.
in stocks, 20% in bonds, 20% in gold, which would be, if
Mhm.
that spread, if that became normal, there wouldn't be enough gold to satisfy the demand, So you would see gold also become unobtainium in that case. But if that were to happen and gold were to go up because of that, then you'd see silver go up even more for the reasons we
Mhm.
just talked about. So
Yeah.
and you might see silver as part of gold in your 60-20-20 portfolio. And that would be insane from the price standpoint because there is nowhere near enough precious metals to satisfy mainstream investment demand if something like that happens.
Mhm. Wall Street might be reacting to something else that you've written about as well. This is the idea of gold being the world's new reserve asset. You wrote a piece back on September the 8th that said this is the way Donald Trump wants it. And your thesis is that for most of this century, the world's central banks have held U.S. Treasury bonds as their primary reserve asset. But lately, for a variety of reasons, they're converting their dollars into gold. And you say that this year the lines crossed as the amount of gold they own actually exceeded their treasuries. So that's a trend that's happening at the same time and is probably impacting the way Wall Street is advising people as well.
Yeah, a big
Would you
part of
agree?
the yeah, big reason that gold has been going up is that central banks have been buying it for the first time in decades.
Hmm.
And they're buying gold for a couple of reasons. One is that they see the currency crisis that's coming. They know how much new currency they have to create in order to stabilize their currency. So they're buying gold as protection against major declines in dollars, which were their other major reserve asset. And the other reason a lot of central banks are buying gold is that the dollar has basically weaponized its privilege in having the world's reserve currency. So anybody crosses the U.S. out there, and we kick them out of the SWIFT international bank settlement system, or we sanction their products in international trade, and we can do that because everybody has to have dollars So if we withhold our dollars from an adversary, we can cause them a lot of trouble. And so countries like China and Russia, and to an extent India and Saudi Arabia, are sick of that. They're sick of being bullied by the U.S. government. And they're setting up their own parallel currency system via the BRICS countries organization. BRICS stands for Brazil, Russia, China, India, and South Africa. And
Mhm.
so they're setting up a separate monetary system that is based on gold. And so their central banks are buying gold like crazy without being price sensitive. That's a big part of the reason why the gold bull market has been so smooth over the last couple of years. And that's because central banks are buying it because they have a target of tons that they need to own, not a price that they need to pay. So they'll pay more because they're, the dictator of their country has told them to get X number of tons of gold, and they're going to do that regardless of what they have to pay. And so that's phenomenally good for gold because central banks have unlimited money to spend, basically, right? They have a printing press. They
Yeah.
create money out of thin air. They can buy gold, and they can buy it at any price. And
Mm.
that's, yet another reason why this bull market probably has legs, because we aren't there yet for a lot of these central banks. They still need more gold to get to their probable targets. So they're going to
Mm.
continue to be buying going forward, and that kind of puts a floor under the price of gold.
Fascinating. Folks, we've been talking with John Rubino. He is an author and uh, investment and economic analyst who's written several books. And we're going to talk about them now. We're actually adding a few of his books to our reading list. One of them is called The Collapse of the Dollar and How to Profit from It. And the thesis of this book is that the dollar is in trouble. Its value on foreign exchange markets has been falling for the past 6 years, and now its gradual decline is about to become a rout. And you say, John, this spells big trouble for the American economy, but potential riches for smart investors. And so this is kind of a follow up to your previous books. One of them, The Collapse of the Dollar and How to Profit from It, that we talked about earlier. But you provide advice in this book about, you say, look, the dollar is collapsing. Here's why. You've talked a little bit about that on the show today. But you also provide practical advice to investors about maybe how they can profit from that collapse when they see it coming. Is that kind of the thesis of this book and why you wrote it?
Well, yeah, that was an investment book. The thesis was we're screwing up the global monetary system. And the bulk of the book was what you can do about it. And basically, you want to stop trusting the fiat currencies of the world and the instruments that are based on them, like a government bond, for instance. It's supposed to be super safe. It's supposed to be a risk-free asset, but it pays you interest in dollars and then gives you back the dollars you put into it at the end of the bond's term. Well, if those dollars go down in value, then that bond goes down in value too. I mean, they're paying you depreciating currency in each month or each year. And at the end, they give you back a bunch of depreciated dollars. So you actually lose money in real terms by owning something that the government tells you is risk-free. And
That doesn't
it's the
sound
same
good.
thing with, no. But see, um, mainstream, the conventional wisdom is that's the safe part of your portfolio. You buy these
Mm.
government bonds and you always get your money back. Well, you'll get your number of dollars back that you're supposed to get, but those dollars will be less valuable. So you will actually lose money in real terms. Your capital will diminish. And so you want to
Mhm.
learn that lesson and get away from stuff like that. Bank stocks. If you own shares of JP Morgan Chase, you've made a lot of money. You've done great. Congratulations. But most of JP Morgan Chase's assets depend for the dollar on the dollar for their value.
Mm.
So therefore, JP Morgan stock is in the same boat. So you don't want to
Yeah.
own asset or financial stocks,
Mhm.
but you
Mhm.
do want to own things that either are real assets, like gold and silver, for instance, are both real assets. Governments can't create more of them, and they don't have any counterparty risk. In other words, nobody has to keep a promise for your gold and silver to maintain their value.
Is that also
Um,
true of Bitcoin, John?
I've been trying to understand Bitcoin and cryptos in general, and I've
Me
never been
too.
able to. Yeah,
Yeah.
because Bitcoin does not physically exist.
Right. Yeah. It's not
You can't
tangible.
just
Yeah.
reach into your pocket and show me a Bitcoin. You can't do that because there is
Yeah.
no physical Bitcoin that exists in the world.
Yeah.
And on the other hand, it's limited by the creation algorithm to a certain number of coins, and that's all there will ever be. Which means
Hmm.
it's nice and rare, which is one of the criteria for a functioning form of money.
Right.
And the blockchain on which Bitcoin trades is they call it inviolable, and but it's a distributed ledger, so everybody is getting the same information at the same time, so you can't go any one place to manipulate it. So there are reasons to think Bitcoin is extremely cool, and it might be a form of money in the future, but I haven't completely figured out the thesis in a way that
Hmm.
would allow me to say anything with any kind of certainty. With gold, it's very easy to say, okay, money for 3,000 years, um, very limited supply. It's physical and it doesn't go anywhere. You can leave it at the bottom of the ocean for 1,000 years and it's still just as good as it was
Yeah.
when you dropped it in there.
Yeah.
That's all true for gold. That's a thesis.
Yeah.
But with Bitcoin, I can't compose something that's that ironclad. So I
Hmm.
don't want to tell
Hmm.
people to be in cryptos or not be in cryptos. I'm just going to stand on the sidelines and watch that play out and stick with my stodgy
Yeah.
old gold and silver.
Well, and it comes back to something you said earlier that really resonates with me, and that is the relationship between gold and truth, and reality, right? And so that's something that is a prerequisite for your advice, and this makes sense. It's also in another one of your books called Main Street, Not Wall Street: Investing Close to Home, the Smart Way to Make More Money. This type of book, it seems unusual coming from somebody who was on Wall Street, but maybe as somebody who is a personal, a self-designed exile from Wall Street, you left that behind. But this book focuses on using real life examples, showing that when tomorrow's companies are born, their neighbors notice them first. Local papers cover them, and local brokers recommend their stocks. And you have a step-by-step formula showing how people can turn what you see and what you hear into sound investment strategies. You want to talk about this book a little bit because it's a little bit of a different turn than some of the other ones you've written.
When I wrote that book, I was writing for a magazine called Virginia Business. And my job was to cover local businesses from an investor standpoint. So, I did that for a couple of years and realized, that's kind of a catchy book thesis, right? And
Hmm.
I shopped the idea around. I got an agent who got me basically a bidding war for that book. I was, unpublished, completely nobody. And I was able to sell that book. And I, wrote it, handed it in. The book turned out to look good, and it worked out really well. Except it didn't sell.
Yeah.
And part of the reason why it didn't sell was that there were a lot of crazy things going on Wall Street at the time. And the other
Hmm.
part was
Hmm.
that it's hard to market a book if you don't have a big platform of ready-made platform of people who are paying attention to you already, and I didn't. So
Yeah.
that
Yeah.
book didn't sell, but I think the idea is still valid that your one advantage in investing is that you have personal experience that other people don't have. You use certain products, so maybe that this product category that you really care about just got some new entry that's awesome. Well, you go out and you
Hmm.
buy that stock.
Right.
And if you're in a town where there's a new business, like a new restaurant chain, they just have three outlets in your town. They're phenomenal. They're always crowded. They're getting ready to expand. Well, there you go. When as soon as
Yeah.
they issue stock, you go out and buy some of that stock because it might be the next Wendy's or something like that. But you saw it
Right.
first.
Hmm.
Anyhow,
Hmm. Hmm.
that's a thing people should be paying attention to. But
Yeah.
it actually I've seen a lot of great looking local companies never make that next step. They were good
Hmm.
locally
Hmm.
and everybody knew about them, and then that's as far as they went. So I don't know if that's a thesis that I would tell a lot of people to let dominate their investing. It's a thing to pay attention
Yeah.
to, but
Hmm.
I think you still have to broaden your horizons to really get a well diversified portfolio of good assets.
Yeah. It sort of proves, the Adam Smith adage or the maxim that there's no profit without risk. Whatever you're investing in, there's going to be some risk involved.
Hmm.
And of course, I guess that's the fun part about it for people like you and what you do. Folks, we've been talking with John Rubino. He's an author of several books, three of which we're adding to our reading list today. One is called Main Street, Not Wall Street. Another called The Money Bubble. And a third called The Collapse of the Dollar and How to Profit from It, Make a Fortune by Investing in Gold and Other Hard Assets. And that's mostly what we've been talking with John about today. He's also authored two other books that you should check out. John, if people want to find out more about you and to read more of what you're writing, how do they do that? Obviously, there's your Substack. Where else can they find you and your books, for example?
The books are mostly, I think, with the exception of the very first book, are on Amazon. So you can just go there and find everything. But everything I'm writing now is on Substack. It's at rubino.substack.com. And the idea behind the newsletter is the search for actionable ideas for all the crazy times that are coming.
Mm. Well, John, I really enjoy your Substack. That's why I follow it, and I enjoy your writing, and I've really enjoyed our time here today. And I want to thank you so much for being our special guest here today on Gray Matter.
Great. Thanks, Leighton. I enjoyed it.